Hi, I'm Julia from Shortlisted Productions. Today we have a guest speaker, Lyddon, who is an expert in cash management and payments.
I've been running a small private consultancy for about 15 years in payments, international cash management, electronic banking, and recently that's focused more and more on what's happening here in the UK, driven by the political agendas both from the UK government and from Brussels, which culminate now in really the twin track of Open Banking and Payment Services Directive 2. Open Banking is coming out of the Competition and Markets Authority examination of the provision of current accounts and overdrafts for consumers and SMEs. There, the Competition and Markets Authority issued an order to the Open Banking implementation body to make sure that the big 9 banks, actually it's the big 5 here and several more in Northern Ireland, to make sure consumer and SME accounts, the terms and conditions are visible, the eligibility criteria for overdraft are visible, and the terms and conditions of overdraft are visible. Payment Services Directive is an EU directive which is then passed by the European Parliament, the Commission and the Council of Ministers. But being a directive, it then has to be transposed into UK law. And that's done via something called the Payment Services Regulations. Now, PSD2 had these in 2009, and now there'll be a new set which has been drafted and issued by the Treasury quite recently. That's only a few weeks ago. Then it nominates the Payment Systems Regulator as what's called the competent authority. The responsibility for making it bite once implemented is shared between the Financial Conduct Authority and the Payment Systems Regulator. The Open Banking implementation body has been given one lot of work by the Competition and Markets Authority and another lot of work by the Treasury for PSD2, but they're not identical, by no means identical, and there's both a scope problem and a detail problem. The scope problem is the Competition and Markets Authority order just applies to accounts owned by SMEs and consumers, not corporates and not any other kind of body. But it also applies to current accounts and overdrafts. PSD2 doesn't talk about overdrafts at all, or pricing. Its access to accounts is about effectively statements and payment orders, but nothing to do with eligibility for overdrafts or overdraft terms and conditions, or actually the terms and conditions on the current account. PSD2 is limited in its scope to what are called payment accounts. So it's not a mortgage account, it's not a savings account. Yes, it will be most current accounts, but only the current accounts that are accessible through online banking now. So the scope of the two is not quite the same. You've got that part of the workload of open banking that has PSD2 behind it. That's law, that's absolutely imperative. You've got the next level, which has the Competition and Markets Authority order behind it. That is compulsion, but not quite of the same level of compulsion as PSD2. And then you've got the bits of the open banking mandate that don't have any law behind them. There's no shortage of papers to read through, but to tease out of that the what have we actually got to do by when is quite confusing, because the Open Banking Authority is supposed to deliver its first set of standards for what you 9 banks, the 9 biggest banks in the UK and Northern Ireland, what you lot have to do. They're supposed to issue those by the 31st of March. So what's that, a week, 2 weeks? As far as I can glean, they haven't even begun yet. Now, where do we look to for the books of messages that will convey that information, and the other standards? Well, we would look to people like SWIFT, because the main predecessor way of operation is for a corporate. Corporate uses electronic banking system of I don't know, NatWest, but they have accounts at UniCredit, at KBC, and they want to view them. Fine. There's a SWIFT message standard for that to get a daily statement out of that other bank. But that doesn't include conveying the terms and conditions of the account, or the overdraft, or the terms of an overdraft. It's very limited. It's the debits and credits that went across that account yesterday. Well, there's another one which SWIFT are also involved with, but are not the main controller of, called ISO 20022. Coincidentally, it's Payments UK who are the main mover on that. They're called the Registration Management Authority. But even that book concentrates on the statements on accounts, not on these other eligibility criteria, terms and conditions, also not on things that you normally see in an electronic banking system, like your lists of standing orders, lists of direct debits, list of regular payees. There is no precedent in the SWIFT world, either in the more traditional standards, which are called MT, or the newer ones, ISO 20022, for that data to be exchanged. You know, this is not a trivial thing to design a whole series of messages to convey data that's never been conveyed between different parties before. And it's not just the standards, the data format and the content. There has to be market practice around that. So the market practice would have to be what is reasonable for this third party to request, how often they want data, how much data, what data, as well as the actual spec. And to my mind, none of that exists. The source bank would generally say, we have a business model for producing intraday reports. You will get either a statement once every 2 or 3 hours, which follows two ways of doing it. Either every 2 hours we give you every transaction over the account from beginning of business, from start of play to now, or we give you every transaction that went over the account since the last one. But generally they'd only produce that 4 times a day. And what they do is time that to be coordinated with when the clearing systems in that country send their files to the bank. So the clearing systems are not always online. They work on big batches. So batch turns up at 10 o'clock, probably takes half an hour to post it because it's got millions of items. So you'd expect then an intraday report at 10:45. It wouldn't be uncommon for an intraday report from a major bank to require inputs from 20 or 30 different internal systems just to produce that list of transactions. And in fact, another arm of the European authorities, called the European Banking Authority, has issued already some technical standards about how this should be done under PSD2. And they are saying, yeah, the third party can't expect the source banks to produce reports more than 4 times a day. Implementation of access to accounts by any financial institution should include a substantial substream of work saying, how do we square this off against general data protection regulation? That's huge, and the threat is not only that the fines will be very large, but there'll be great disclosure. I mean, I think we knew what happened to TalkTalk when they'd had a data breach. That would be the kind of exposure that a financial institution would risk. So at the same time as we're talking about these third parties having the right to demand that a bank effectively open its books, you have much higher penalties and risks for the bank of doing that. Banking data is secret and private, and the technology is going to put that data out in the cloud. One way or another, that is going out into computers, other computers. And then, yes, who is responsible then? where does the bank's responsibility finish? Do they actually have an exposure on each and every one of these third parties, regardless of the fact that they've handed the data over? I think it's unclear, and I mean, I'm not a data protection lawyer, but who remains the data manager? However much the information providers are scared about data protection, the third parties ought to be very scared as well, and they're not scared enough. Because recently some charities were very heavily fined by the UK Information Commissioner for processing information, private information, in a way for which the customers hadn't given very, very explicit permission. Of course, we've got a lot of new entrants, but as they've been there for 2 or 3 years, they're not regarded as new entrants anymore, such as e-money institutions, payment institutions, and there are 4 or 5 challenger banks, new banks that have been set up. But from the point of view of PSD2, they are no longer regarded as challengers. They are grouped with the incumbents. So having set themselves up to challenge, now they also have to open their books. And I think that's causing quite a lot of problems. Is, hey, wait a minute, I'm the challenger. No, you're not the challenger anymore. You're regarded as an incumbent. You are what's known as an account servicing payment service provider, whether you're e-money, payment institution, credit institution. You've got to open your books to these third parties. Oh gosh, wait a minute. You know, we're a small company. General data protection regulations. Now very troubling that suddenly we're the one having to be the object of these regulations, helping somebody else get into the game when we've hardly got into the game ourselves. And also, one of the curious things is that although PSD comes into play January 2018, these new regulatory technical standards are not likely to be enforced until November 2018. So you've got this really difficult first 10 or 11 months where we're dealing with what's out there now. I mean, my advice to customers has been, firstly, well, this is banks. If you don't have customers, SME and consumer customers asking for this now, the best thing you can do between January 2018 and November 2018 is just offer an end of day statement and say you're working on the proper full McCoy to be available from November. Now, if the customer or the third party started trying to sue or bring a complaint through the competent authorities, frankly, you can kick that into the long grass for 11 months, by which time you'll have the full offering. So forget about January to October 2018, just go for the full offering, target date November 2018. Then the troublesome thing is that the requirements are that whatever the customer can see through your online banking system, you must enable them to do and see through a third party. Now there you come into the difficulty of you can see your direct debits and your standing orders, but making that available through to a third party, there's no test material there, there's no body of message books. So my advice to there would be just wait. You know, somebody's got to come up with a message book or a way of doing it. Don't try going out on your own, because if you do it one way and then market practice delivers another, not only have you wasted your money on your way, you've got to pay more to undo your way and then rebuild. So again, go with the flow, go with the crowd. I do wonder whether the consumers are really half as excited about this as these third parties themselves. Equifax recently, perhaps a month ago, came out with some research that really a very large majority of UK consumers, firstly, they'd never heard of open banking, and then even of that lot, the number that would use it was very, very few. So one does wonder if there's a bit of an echo chamber in between the regulators and the fintechs to big up the interest of consumers and SMEs in all of this. If you've got several different banks, Firstly, you should be able to see what are the balances on all your accounts added together as one number. Secondly, make it easier to move money in between the different accounts to make sure you're not in overdraft there while you've got long balance somewhere else. So better cash management. Then, assuming that the third party can get a proper granular detail on the debits and credits going across your accounts, you could see some kind of budget management application showing how much you're spending on water, electricity and gas, how much on going to the cinema, how much on eating out, how much on groceries and so on. What next? Well, I suppose making all your payments through this one channel on mobile. I mean, it's going to be mobile or tablet rather than sitting down at a PC. Having a stored value on your card or device and being able to do all your payments like that. I mean, okay, that's great, isn't it? Is it exciting? It's the kind of thing that a major corporate would do because they have to. It's part of the discipline of running a major corporation. Is that exciting? I don't know. Personally, I don't find it very exciting. I don't necessarily want to do banking all day on any kind of device. Ease of making payments, it's not as if you can't do it already. I have a feeling, again, that in the echo chamber between regulators and fintechs, this is highly exciting, but I do wonder to what extent that excitement will be shared by the consumer. Well, there's no doubt that there will be a lot of third parties trying to set themselves up. For example, when PSD2 set up this status of a specialist payment company, payment institution, there are 1,000 of them. Now, those all set themselves up, but as of now, less than half are operational, the rest having been blocked in their business by the one or other regulation that came in. Now, to me, it's a questionable whether in an environment where we have zero interest rates, where the objective of successive regulations has been to cut pricing, make pricing more transparent, so you have to be told what the fees are in advance to make your own mind up. There's none of these funny adjustments on value dates when the booking date of a deal, a transaction is different from its value date. Interchange fees on card business have been cut back. Where's the money? How do people make money? Or do we go into an environment where players are subsidized by venture capital investors who never want to see a profit, and you get actually a distortion because you have one set of players, banks, who are forced to make a profit. They can't lose money because then they deplete their regulatory capital. You can deplete your capital contrary to the Basel III regulations by not just by paying a dividend or paying huge bonuses, but by losing a lot of money. So they're not allowed to run a business that loses a lot of money, whereas you have a number of new entrants. If you look at Snapchat, never made money. The more you lose, the better it is. That in itself is a distortion of competition. And if you get players in who are expecting to make money out of payments or by holding account balances, they're going to be sorely disappointed. So I just wonder, I could imagine 5 years down the line we'll have seen a lot of new players in, and then there'll have to be some kind of shakeout like there was in .com. But nevertheless, yes, in the short term, there'll be a lot of new players coming in.
Shortlisted Productions specialise in the production of business video content for corporate clients. Please contact us for a free quote at shortlistedproductions.com.